Hello and welcome. In this video, we will learn about expiry and physical settlement. Okay. Now, on expiry, index options are cash settled and stock options are physically settled. Okay. If you buy an index option and if you hold it till expiry, upon expiry, index options are cash settled, and if you buy a stock option and hold it till expiry, stock options are physically settled. Now, what is cash settled and what is physically settled, we will see in detail. Okay. Now, first we will see about expiry for index options and stock options. Okay. Now, this is the option chain of Nifty. Nifty is an index. Okay. You can see it has many expiries. Alright, many expiries. The indices have weekly expiry, expiring every Thursday, monthly expiry, expiring the last Thursday of the month. It has quarterly expiries that happen every 3 months, and then yearly expiries. Okay, so if you see here, this is of this week, this is of next week or next Thursday, the Thursday after that, Thursday after that. Okay, so this is also the monthly expiry. So here this is monthly expiry, this is monthly expiry. Okay, this is monthly expiry. If you see here, we have June 26 also, December 26 also, June 27 also, December 27 also. All right. Now, the options having quarterly expiries or yearly expiries are called as long-term options, and the ones that have weekly expiries and monthly expiries are called as short-term options. Okay. Now, the stock options have only monthly expiries. So this is of Axis Bank. This is of Axis Bank, and you can see it has only monthly expiries. There are no weekly expiries here or long-term expiries here. This is of current month, this is of next month, this is of following month. Last Thursday of every month is when the option will be expiring. Okay. So this is about expiry. Stock options have monthly expiries only. Index options have weekly, monthly, quarterly and yearly. Okay. Now, let us take the example of index and see how they are cash settled on expiry. Okay. So first I will consider the example of call option and I will consider the example of Nifty. Let us say that the spot price of Nifty is 18,000. Okay. So the current price, spot price, current price is 18,000. Alright. Spot price. Now this is not rupees, this is of an index, so 18,000, that's all. Okay. 50 is the lot size of Nifty. Okay, 50 is the lot size. Let us say that I buy an option of 18300, this strike price on 3rd June. Let us say that I am the buyer of a call option and I buy the strike price 18,300 on 3rd June 2023. Okay. The expiry of the option is on 29th June 2023. Let us say that. Okay. To buy the option, to buy one lot of 18,300 strike price, I need to pay a premium of 100 rupees into lot size, which is 5,000 rupees. So by paying 5,000 rupees to the seller, I have bought one lot of Nifty options on 3rd June 2023 of 18,300 strike price. Okay. Now, let us say that on 29th June, that is upon expiry, the spot price is 18,500. Okay. Spot price of Nifty reaches 18,500. Now, what did I buy or what had I bought? I had bought 18,300 call option. 18,300 call option, meaning I had expected the price to go above 18,300. Okay. So it has gone to 18,500. So there is a difference of 200 points here. 200 points. Okay. So buyer of the option gets 200 into 50, which is 1,000 rupees in his account. Okay. Buyer of the option gets 200 into 50, which is 10,000 rupees in his account. Alright. And the seller of the option has to pay 10,000 rupees to the buyer. Whatever the buyer gets is whatever the seller loses. So if he gets 10,000, the seller loses 10,000. Okay. Now, when I say 10,000, this also includes the premium that the buyer had paid to the seller. Buyer had paid 5,000 rupees, correct, to the seller while buying the option. So that is included in this. So ultimately the profit is only 5,000 rupees. Okay. If we come here, this is 10,000. This also includes the premium that the seller had obtained from the buyer. While selling the option, the seller had received 5,000 rupees premium from the buyer, correct? So he is giving back that amount and along with that extra 5,000 rupees. So totally 5,000 rupees is the loss to the seller. Okay. So this is what is meant by cash settlement. Okay, cash settlement. Index options have cash settlement. Okay, and this is only if you hold the option till expiry. You had bought it on June 2nd or 3rd, and if you had held it till June 29th and upon expiry, this is the calculation. Okay. Now going to put option. Nifty spot price is 18,000, lot size 50, date of buying 3rd June, expiry 29th June. Let us say that I am the buyer of put option and I buy the option of this strike price. The premium is this much and I pay this much to the seller of put option. Okay, same calculation like before. Now on 29th June, let us say the spot price reaches 17,500. I had bought 17,800 PE. So there is a 300 point difference in this. And so buyer of the option, which is me, I get 300 into 50, which is 15,000 rupees in my account. And the seller of the option has to pay 15,000 rupees to the buyer, which is me. Now remember that this price or this money includes the premium that I had paid to the seller. So totally my profit is 10,000 rupees. Whereas here this includes the premium that the seller had received from me or the buyer. So total loss of the seller is 10,000 rupees. Okay. So this is what is meant by cash settlement. You get cash according to the difference in points upon expiry. Okay. Now we will take the example of stock options. Okay, stock options. Let me take the example of Asian Paints. Stock price as of 3rd June is 3135 rupees. Okay. And let us say that I buy one lot of this strike price by paying a premium of 20.45 rupees. So 20.45 into 200 lot size is this much rupees. So I have paid this much to the seller and have bought one lot of Asian Paints option of this strike price. Okay, this strike price. Now, on 29th June, let us say that the stock price reaches 3250 rupees. Okay, it has moved in my direction and it has gone above this value, and it has reached this point. It has reached this point. I had bought option of this strike price, correct? Yes. Now, if I hold this option till expiry, if I hold this option till expiry, then it will be physically settled, meaning I have to take the delivery of the shares, meaning I have to buy the stocks at the strike price. Okay, so then how much should I pay? I have to pay this much. Okay, I have to pay this much rupees. See, this is when, or this is if I hold the option till expiry. Okay, upon expiry, I have to buy the stocks at this strike price. Okay, I have to buy the stock. Now, why this price? Because this was the deal price, correct? I had made a deal to buy the stocks at 3180 rupees. It has gone above this, but I have an option to buy at this price. So I have to buy at this price. So 3180 into lot size. So I have to buy 200 stocks by paying this much amount per stock. So I need to pay 6,36,000 rupees and buy 200 shares. When I do that, I can see that I have 200 shares in my demat account or trading account. Okay, I will get physical delivery of the shares. Alright, so this is not what I will have in my account, or this is not what I will be looking at. Alright, I have to pay this much. I have to pay this much and buy the shares. Alright, and the seller has to give the shares to me. Or see, I am buying 200 shares, correct? Someone has to sell it to me. So the seller has to sell it to me. The seller has to give 200 shares to the buyer at the strike price. That means seller has to have 200 shares of Asian Paints in his account. He needs to have 200 shares in his account. Only then he can give me the shares or sell me the shares. If he doesn't have, then he has to buy it and he has to give it to me. Alright, I hope it is clear. I have to pay full amount and buy the shares. Seller has to sell the shares to me at the strike price. That was the deal, correct? That was the deal. And this delivery of shares on the expiry is called as physical settlement. Okay, physical settlement. This is why traders do not hold the option till the date of expiry. Okay. Now what happens is 1 week before expiry, the brokers will start to ask money, meaning they will tell us to keep the money ready to buy the stocks. Okay, so 1 week before the expiry, they will say, please maintain 1 lakh rupees in your account. And then 6 days before expiry, they will say, maintain 2 lakh rupees in your account. Then 4 days before expiry, they will say, maintain 3 lakh rupees in your account. So on, it continues till the date of expiry. And on the day of expiry, this much money needs to be in your account. It has to be there in your account. If it is not there, if you do not add money to your demat account, the broker will square off the position, meaning broker will book the profit or book the loss, whatever it is. Okay, book the profit or book the loss. I hope it is clear. This is why we do not hold the stock options till the date of expiry. We square off the position 1 week before expiry and then buy the options of next month if required. Okay, current month position we will be closing and we will be buying next month expiry. Clear? Index options are cash settled. You don't have to pay anything and you don't have to buy anything. The difference amount is settled by cash. But here you have to buy the stocks or you have to sell the stocks if you are a seller. Okay. Next, moving to put options. Okay. Same conditions. Asian Paint stock price is 3135 rupees on 3rd June and I buy one lot of 3100 strike price option by paying this much premium. Okay. So this into 200 is 4040 rupees. So I pay this much to the seller and I buy 3100 put option. Okay. My expectation is that this stock price will move below 3100 rupees. Alright. Now, on expiry on 29th June, let us say the stock price reaches 3000 rupees. Okay, 3000 rupees. I have a right to sell the stocks at 3100 rupees. Correct? Put option means right to sell. So, I have the option and I have the obligation to sell the share. So, I have to sell the shares at the strike price. Now, we are talking about put option, correct? We have bought or I have bought the option, put option means I have a right to sell the share. So, I have to sell the share at the strike price. I have to sell the shares at the strike price. So, physical delivery or physical settlement will be made on 29th June. So, 200 stocks at this price must be sold to the buyer. Buyer meaning the seller. The seller has to buy 200 shares at the strike price. I hope it is clear. I am the buyer of the put option, but I have to sell the shares. Seller of the put option has to buy the shares at the strike price. Okay. So, I need to or he needs to have the entire amount in his account to buy the shares. And as I have mentioned before, we do not do that. We square off the position 1 week before expiry. Okay, because we need to have entire amount of money in our account to buy the shares, correct? Buy the shares. If we do not have that, the broker will automatically square off. So, to avoid all these trouble, we traders sell off or square off the position 1 week before expiry. Alright. So, I hope the concept of physical settlement is clear. Now, this physical settlement is only if the option expires in the money. Okay. Only if the option becomes in the money, there will be physical settlement. If the option expires at the money or out of the money, then the options will expire worthless. Alright. I hope you are able to understand. If the option is or it becomes at the money or out of the money upon expiry, then they will expire worthless, meaning the premium that has been paid by the buyer will be lost. That's all. Okay. If the option that has been bought becomes in the money, physical settlement will be made. Alright. Yes. And one more thing you need to know is that this is European style option. Okay. European style option. PE. Correct. European. So physical settlement will be made only on the date of expiry. Okay, only on the day of expiry. Whereas American style options, if you have American style options, you can go for physical settlement any day before expiry. Okay, any day before expiry. Meaning, let us say you had bought the option on June 3rd, and on June 4th the stock price has moved in your direction. So if you want to go to, or if you want to opt for physical delivery, you can do it on June 4th itself. You don't have to wait till expiry. Alright. Whereas in this case, European style, you can go for physical delivery only on the day of expiry. Alright. I hope it is clear. So that's it for this video. I'll see you in the next video. Till then, take care and thank you for watching.